Okay, hello everybody. It's just slightly past 12 o'clock, so we'll start today's session. My name is James Sharp. I'm an actuary and I'm hosting today's CPD session brought to you by the Network of Consulting Actuaries. The Network of Consulting Actuaries is a growing independent organisation comprising of actuaries committed to developing and sharing knowledge amongst their fellow actuaries. Our vision is to make a positive contribution to the ongoing development of the financial sector. Today's session is titled A New Method for Discrimination-Free Pricing by Ron Richman. Just on Ron's background a little bit. So Ron Richman is Chief Actuary at Old Mutual Insure. He's responsible for oversight of all actuarial activities in the OMI group. Ron is a Fellow of the Institute and Faculty of Actuaries and the Actuarial Society of South Africa. Ron holds practicing certificates in short-term insurance and life insurance from the Actuarial Society of South Africa and a Master's of Philosophy and Actuarial Science with distinction from the University of Cape Town. He chairs the Actuarial Society of South Africa's Climate Change Committee and is a member of the Aston Board. Ron is giving this presentation in his personal capacity. The views expressed in the presentation are those of Ron and not necessarily the views of his employer, the Network of Consulting Actuaries or the Institute of Actuaries. The slides for today's events, they're on our website, www.noca.uk, and navigate to the events page. The session could count up for up to 1 hour of your CPD, provided it's relevant to the nature of your work. If you have any questions, please just type questions on the panel on Zoom, or you can tweet us at NOCA_UK on Twitter. There'll be time for questions at the end, but yeah, with that, I'll hand over to you, Ron, for the presentation.
James, thanks very much for the opportunity to present to you and to your audience. It's always a pleasure I think it's the second time I've been presenting to this audience, and I always appreciate the activities you guys run. That being said, thanks for the opportunity again. What we're going to cover today is just a bit of an introduction to this idea of discrimination-free pricing, which is something I've been very privileged to work with my co-authors on. We'll give a bit of a synthetic example showing how this actually works. We'll then talk about an issue with the original discrimination-free pricing methodology, which was that you often have missing discriminatory information, and we'll show how to solve that using multitask neural networks. We'll look at a really interesting real-world example where a certain unnamed insurer had collected some data around ethnicity, and we'll show what happens when you price using this data and how you can improve this using discrimination-free pricing, and then we'll discuss the outlook and some conclusions. So this is joint work with Mario Wuttrich, Matthias Lindholm, and Andreas Sanakas. We've written 2 papers on the topic. One was published in the Aston Bulletin. Another one is on archive currently, and you can access both of these for free in case you'd like to read up more. So what is the rationale for thinking about discrimination-free pricing? This is what was put out by Root, which is an American insurtech a couple of years ago. They wanted to drop the score. So if you know a little bit about personal lines pricing, you'll know that credit score is a very powerful predictor of insurance risk. But what Root was pointing out in this particular campaign is that credit scores often highly correlated with which community you come from. So if you're an under-resourced community, an immigrant, etc., you'll find that credit scores are lower. And in that case, the lower credit score is not necessarily representative of increased insurance risk. So what I've tried to do is represent this argument graphically on the bottom right-hand part of the slide. Credit score can be a predictor of your price of your insurance policy. And there's the good reason for this is if you look at a paper published not too long ago in the North American Actuarial Journal, they show how credit scores are indicative of sensation seeking and how much self-control a person has, and they surmise that this is connected to the risk profile that a person will have. On the other hand, credit score is also connected to whether or not you're an immigrant or perhaps from a minority ethnicity class in the United States, and that's not something you'd like to capture. And this graph or this diagrammatic representation really illustrates the heart of what we're trying to do in discrimination-free pricing, which is isolate the legitimate impact, without allowing rating factors to capture proxies that you really might not be interested in capturing. This one's a little bit closer to home, so I'm speaking to you from South Africa. And on the right-hand part of the slide, we have an aerial photograph of an affluent suburb in Johannesburg, together with across the road, a very much more impoverished suburb. And a lot of these clear demarcations are as a result of the policies under apartheid, which segregated people by ethnicity. And you can almost bet that the people on the right will generally be of African descent and the people on the left will generally not, just given the way South Africa has been shaped by the illegitimate apartheid laws. So you can again represent this quite neatly using the diagram on the left-hand part of the slide. Geographic factors will be captured by your postal code, and those probably have a legitimate influence on the price of your insurance. But on the other hand, race in South Africa will very strongly be captured by your postal code, and you definitely don't want to be pricing using any sort of racial proxy, whether explicitly or implicitly. And really what we're going to try tackle today is how do we isolate the legitimate part and get rid of the part that's not legitimate and probably unethical at the same for the same price. Okay, so let's start looking at discrimination-free pricing. So the current environment in personal lines pricing, in general insurance, but also to some extent in life insurance, is more advanced techniques are becoming quite widely known and used. And there's quite a lot of regulatory scrutiny on pricing. So the FCA banned price hawking a year or two ago, and there's a lot more scrutiny on exactly how pricing happens. If you think about legal and ethical requirements, so there's definitely a legal ban on gender-based pricing in the EU and still in the UK. But I think also beyond legal concerns, there's also ethical concerns. If you're an actuary working in the South African environment and you've got postal code, can you legitimately justify that what you're doing makes sense from a rating perspective? So how can we ensure our models are not influenced by the sort of discriminatory factors that we've mentioned earlier? So what you could do is you could just ignore the problem, leave out the discriminatory rating factors and hope the problem goes away. What you might wonder about is that perhaps advanced models might figure out proxies for these factors. And what we're going to show in the next couple of examples is that even simple models can do this. So let's have a look just at the EU legal basis. So the legal basis prohibits two things. The first thing it prohibits is direct discrimination. But the other thing it prohibits is indirect discrimination. This is where an apparently neutral provision puts people of one sex at a particular disadvantage compared to people of the other sex. And this very easily can happen, this sort of indirect discrimination, if you include covariates or rating factors in pricing models that can indirectly proxy for gender. And you can pick up much of the same effect. A classic example of this, now that telematics data is becoming more widely available, is that it's quite well known that men drive further than women in a particular year. So just by including total distance driven, you may already have a proxy based on telematics data for gender, and you could construe this as being indirect discrimination according to the EU directive. Maybe just an important thing to say, I don't think the point of this presentation is to say what should be classified as a discriminatory factor or not. I don't think that's an actuarial problem. I think that's a legal and moral and ethical problem. But once those definitions have been given, what can we do about that from an actuarial perspective? And that's really the area in which we'd like to address things today. Let's look at some definitions. Generally, your insurance pricing models are often a best estimate plus some sort of risk margin. And just a little bit of notation, we'll call our claims costs that we're trying to predict Y. Your non-discriminatory covariates we'll call X, and your discriminatory covariates we're going to call D. And generally, your best estimate prices take account of all of your rating factors. So you'll have a price which we show as mu, X, and D, which is generally set equal to your conditional expectation. And for complex lines of business like personal lines, you'll approximate this conditional expectation using a regression model. And what you can see is that this best estimate price discriminates on D because you're explicitly including it. And then another approach that we mentioned before is let's just ignore D and hope that X and D are suitably uncorrelated. And then we're going to show throughout this presentation that this generally doesn't work so well. So let's look at the first example. This is a very simple two-way rating problem where you've got smokers, non-smokers, women and men, and you'd like to price your costs for smokers and non-smokers. So let's say that you don't want to price with gender, you only want to differentiate by smoking status. And in this particular example, the conditional probability of being a woman, given that you are a smoker, is about 85%. So smoker or not is a pretty good proxy for being female or not. So what you could do is you could just calculate your overall smokers rate, which is a frequency of 0.229. But what you can also show is that you can decompose this frequency by looking at your gender-specific rates multiplied by the conditional probability of being in each gender given your smoker status. So what this effectively means is that taking the naive approach of just saying, hey, what's our smoker frequency, actually implicitly includes or is equivalent to looking at the conditional probabilities of being a male or a female given your smoker status. So you're effectively implicitly inferring gender based on your smoking status. This is about the most simple example that you can come up with. And this really goes to show that the naive approach of just not including discriminatory covariates can pretty easily be decomposed to something that does include these covariates. Let's look at another example. So what should we do about this? What should the discrimination-free price be? On the left-hand side, we've got a portfolio distribution of the probability of being female or male given your age. So you can see it's mainly females up to about age 50, after which it is males. And on the right-hand side, we've got our actual known insurance costs. These are your best estimate costs. And maybe just think about what would a good discrimination-free price be in this case. So I don't see any questions from the audience, which you're welcome to ask. But what we'd like to propose is that the discrimination-free price is what's shown in yellow on this graph. In other words, it's a price that lies exactly between your costs for males and your costs for females without paying any attention to the portfolio distribution. What the green line shows is what you derive if you used an unawareness price. And you can see that effectively your unawareness price is a proxy for your discriminatory factors. So what the rest of the presentation is going to be about is how do we derive the yellow line for complex models, and how do we potentially have a way of moving away from the green line if you as the pricing actuary think that that's what you need to do. Let's define discrimination-free pricing. So what we want to do is decouple your non-discriminatory covariates and your discriminatory covariates. And what our proposal basically boils down to is get your best estimate prices, including your discriminatory factor using a model, and take a weighted average of the prices where the weights are independent of your non-discriminatory covariates, which can act as proxies for your discriminatory covariates. So that's the first formula in the middle slide. You average over your best estimate prices, and the probability you use, the factor that you use, is independent of your discriminatory covariates. You can also show that the unawareness price, just like we did before, is in fact the same thing, where you have a best estimate price, including your discriminatory covariates, but you use a conditional probability that to do your averaging. So this is very similar to what we showed before with the smokers, that your unawareness price really is a conditional, uses the conditional probabilities of being in each level of your discriminatory factors. I'm not going to give the formal definition of the discrimination-free price that we propose. There's a lot of this in the first paper that I mentioned, and if you're interested, you can read more about it there. Okay, so let's go back to the example. How would we come up with a discrimination-free price? What we would say is, let's look at your overall portfolio probabilities of being a woman or a man. Let's work out your frequencies for your woman and for your men. And effectively, that price that you come up with is 0.2. It's a little bit lower than the unawareness price. And what this effectively means is that we've calculated a discrimination-free price that doesn't take account of the conditional probabilities that you can work out from your other factors which act as proxies. I just want to talk a little bit about causal inference. So causal inference is the science or the art of making causal inferences from observational data. This isn't something we often care about in actuarial work. Generally, we care about prediction, not inference. The one exception I'm aware of is price optimization in non-life pricing. Pricing factors in most jurisdictions in the world don't need to reflect causal mechanisms. In other words, correlation is good enough. But in other disciplines, they really do care about making causal inferences. So in medicine, you don't want to offer someone a drug before it's gone through a randomized controlled trial, which tells you, does drug X actually cause the effect you care about? You can infer causality based on observational data, so you don't need to do these randomized controlled trials. And what you need to do is control for variables that can cause an incorrect inference, like selection bias or confounding. What you can find if you are involved in causal inference, or you've read a little bit about it, is that in fact the formula that we gave above for your discrimination-free price is exactly the formula used in causal inference to calculate the effect of one variable after you've removed the confounding effects of other variables. So if you look at the little plot on the top right-hand part of the slide, what we're trying to illustrate is you've got your discriminatory covariates, your non-discriminatory covariates, and your outcomes. And your discriminatory covariates will both influence your non-discriminatory covariates. So for example, if you are female, you might prefer a certain type of car. And then the type of car that you have will also influence your claims history. What you try to do in causal inference is get rid of the effect of confounding, and you only want the pure influence, or the uncontaminated influence, if you can put it that way, of your non-discriminatory covariates on your outcome. And that's exactly what we're trying to do in the discrimination-free price. For those of you who've done some machine learning, this is also the same as Friedman's partial dependence plot, which tries to infer or tries to give you a feeling for what is the impact of one variable in a machine learning model on the outcome. James, I see we have a question. Would you like to take it now? I see the question is, who are the authors of the book? This is a great introduction to causal inference. It's Judea Pearl and Dana McKenzie. It's called The Book of Why. And if you're interested in learning a little bit more about causal inference and how it can be done from this sort of data, I highly recommend reading it. It's really fascinating and quite challenging if you're coming from an actuarial background. Okay, so hopefully that answers the question. So what we now can move on to is, let's look at a simple synthetic example of how we could apply this. So what we have is a setup in health insurance, and let's say our non-discriminatory characteristics are age and smoking status, and your discriminatory covariate is gender. And the claims costs are set up in the way that's shown in the middle of the slide. You have birthing costs, which we've assumed only affect women of ages 20 to 40, cancer costs, which depend on age, and there's a higher frequency with smokers and women, and other costs which depend only on age. And the total costs in the simulated portfolio are the sum of these three. We simulated a portfolio of 100,000 policyholders. We assumed 45% are women. We assumed that 30% are smokers, but the most important one is the fact that smoking and being a woman is set up in such a way that the conditional probability of being a smoker, given that you're female, is 80%. In other words, smoking status is a good proxy for gender in this particular example. And what we show over here is, in exactly this setup, what are your best estimate prices for women and men? So that's the red and black lines on the graphs. The two different panels, on the left hand you've got smoke, on the right hand you've got non-smokers. And then you have the unawareness price. You can see the unawareness price in blue really tracks price for females. And that's exactly like we said before, that costs, that smoke is a good proxy for being female. And then the discrimination-free price is really bang in the middle. It doesn't track or use a proxying effect of one variable to indicate what the discriminatory covariates are. And that's exactly the proposal that we're trying to put forward in the discrimination-free pricing example. We're trying to get the effect of your non-discriminatory covariate without a proxying effect for other covariates that you don't want to bring in. Let's just have a look at a slightly different example where we've reversed things. in this example, we said the probability of being a woman, given that you're a smoker, is only 20%. And you can see that exactly that the unawareness price has reversed itself. So in this particular case, if you're a smoker, you're probably a man. So your unawareness price will track the best estimate cost for men. But again, your discrimination-free price stays exactly where it should without having a proxying effect from the smoker and non-smoker variables. Just a very interesting one. What happens if you fit this using neural networks? So this before was your actual portfolio prices that come out from the simulation. What happens if we try to approximate that with the neural network? The neural network is on the top, and what you can see is your discrimination-free price pretty much looks the way it should, as do your unawareness prices and best estimate prices. If you just fit a GLM and you don't do any feature engineering, you're not going to get great model predictability. But what's very interesting is your discrimination-free price actually seems to act quite well in the context of that GLM model. That means that even if you get the model wrong, your discrimination-free price from the perspective of the model will still be reasonable to some extent or another. Let's just talk about bias correction. So what we're doing when we are coming up with the best estimate price and the unawareness price, these prices will have the property that if you model these and then you sum them up, your total portfolio costs will equal what's coming out the models. In other words, you can price for your aggregate portfolio costs using the unawareness price and the best estimate price. Unfortunately, the discrimination-free prices lose this unbiased property because you're not charging the price implied by the experience. And what you need to do is then correct your discrimination-free prices using any one of several methods. You can use an additive adjustment, you can use ratios, or you could actually adjust the portfolio probabilities to get this right. And effectively what this bias correction does is it allocates all your costs across the portfolio instead of to a particular protected group. So that's really the first two sections. This is what is the introduction to what do we mean by discrimination-free pricing and a synthetic example. Before we proceed to deal with some of the problems that we're trying to sort out in the second paper I mentioned, let's just see if there's any questions or comments from the audience. Come on, James, we need at least one question.
Yeah, I mean, one question I had is this approach actively being used at the moment? Are you using it there in Old Mutual?
So I guess I can neither confirm nor deny what our pricing practices in Old Mutual are, but I will say I found this very useful when reviewing pricing models to at least give you a feeling for what could go wrong. So I found this to be a very useful tool, and I'd be very interested to hear if any of the participants have got any views on this. But I think particularly in a country like South Africa, where you do have a lot of proxies for things like ethnicity, which you most definitely don't want to price with, it's good to just be able to check some of the impacts. And that's what we'll also show in the real world example, which isn't necessarily from a South African insurer, but we do illustrate this sort of process. Okay, so let's move on to the next part of the talk, which is missing data and multicast networks. So what you'll recall is that this discrimination-free price basically can be summarized as get your best estimate prices using your discriminatory covariate. So let's say you're in the EU and you want to get rid of the proxying impact of gender. You'll put your pricing model using gender and then take a weighted average of your prices where the weights don't depend on your non-discriminatory covariates, which can act as proxies. But it's very often the case that your discriminatory covariates are not actually available. So it's sometimes quite difficult to collect very sensitive data such as ethnicity, even if the only goal is to reduce potential discrimination. And that leads to the question, well, how can you practically apply discrimination-free pricing if you don't actually have access to your discriminatory covariate for the whole portfolio? And this is the proposal that I would really like to present to you in the second half of this talk, which is, can we adapt neural networks to work in the case of missing discriminatory information? And to do this, what we're going to need to do is have a little bit of an introduction to neural networks so that everyone, even if you haven't used these sorts of techniques before, will be able to understand what the proposal is. So this is the introduction I always try to give to neural networks, basically to build these up from simple linear regression. So the diagram that you find on the right-hand part of the slide currently on the screen is a very typical diagrammatic representation you'll find in the neural network literature. Each circle represents a variable, and the lines connecting the circles represent your connections between your inputs and outputs. So your input layer represents the variables that you feed into your model. The circle on the right represents your output of the neural network. And effectively what you're doing is you're multiplying your inputs by weights or regression parameters, which are represented by the lines, to get your outputs. And this really shows that a single layer neural network, because there's only one set of inputs in the input layer, is nothing more than a GLM. So this is how you would represent a GLM, which a lot of people are familiar with from pricing in general insurance or mortality analysis as well. This is how you'd represent a GLM using neural network notation. So where things get quite interesting is when you have deep neural networks. So again, the circles represent variables. So the ones on the extreme left represent your input variables. The ones on the extreme right represent your output variable. But what we've introduced in this deep neural network is two intermediate layers of variables. And what happens in each of these is almost as if you're performing a GLM regression on your inputs a number of different times. So you have these intermediate variables where you're forming different combinations of your input variables. And then in the next layer, in the second intermediate layer, you're now forming combinations of the new variables that were formed at the previous part of the network. And then what you're doing is predicting your outputs using these new learned combinations or representations of your input data. So basically all a deep neural network is doing is you're feeding data into it. It's coming up with a number of different transformations of that data, which you specify mathematically when you're building the neural network. And then effectively all you're doing is creating predictions using these new this new representation of your input variables. This is maybe the best way for actuaries who are familiar with GLMs to get a feeling of exactly how neural networks work. If you look at the green block on the extreme right-hand part of the slide, really all a neural network is, it ends in a linear model. And this linear model, or this GLM, uses a learned representation of your input variables, which was learned using the other part of the neural network, which is like a feature extractor. And this is a really powerful concept. All that the neural network is doing is learning a new representation of your data, and then you have a GLM built on top of it. And this is why I think neural networks are a really good model for the actuarial profession to start using more. We're very familiar with linear regression and GLMs, and in this particular instance, you've got a very powerful machine learning model, which is effectively implementing something like a generalized GLM. So what you can do, let's say you're not interested in the GLM to operate on these features, and you wanted to use a different model, for example, boosted trees, you very easily can get rid of the GLM, look at the features that are coming out of your feature extractor in your neural network, and just use those in a different machine learning model. Okay, so now let's start talking about the particular problem at hand. We would like to solve a problem of what happens if you've got missing discriminatory information. And the way we're going to do this is using something called a multi-output network. And this multi-output network is different from most traditional actuarial models. Most traditional actuarial models focus on outputting only a single variable. So you may have a GLM that gives you frequency, you may have a chain ladder model that gives you a single loss development factor. But there's much more general classes of models that output multiple variables. In other words, these have got multivariate outputs. And a representation of what this could look like is shown on the right-hand part of the graph, right-hand part of the slide, where you've effectively got a neural network with two outputs. And this, for example, could be frequency and severity. Or what we're going to be using this model for is to give you an output for each level of your discriminatory covariates. So how would you train these models? Generally, you'd supply examples as the same dimension of the output. So in this case, if you have two outputs, you'd need examples with two variables in them. And really what you'll try to do is minimize a loss function. This is shown on the bottom left-hand part of the screen. You'd like to minimize a loss function that measures how close your predictions from your network are to your examples. And in this case, you've got two, so you need to provide two examples and work from there. What's very nice about this sort of multi-output network is you do all of your feature extraction using the first couple of layers of the network, and then your outputs benefit from the shared representation that your network actually builds for all of your outputs. So this is a good way of enhancing credibility of your modeling. So what we would like to do is, for discrimination-free pricing, is we'd like to predict a price for each level of your discriminatory covariate. And I've just rewritten the formula for your discrimination-free pricing. You can see what you effectively need is a best estimate price for each level of your discriminatory covariate. This might be males and females. And then you're going to take a weighted average. But what the problem is that in a typical personal lines pricing file, you're only going to have a policy that reflects the price for one gender. So you'll only have a record that's, for example, a policy issued to a male person, how many claims did he have? And then for a female person, how many claims did she have? So how can you possibly train a multitask network in this particular case? And what's very interesting is that, and this is really one of the key insights that we had, is you can still train a multitask network even when you're missing data. The way that you can do this is by adapting the loss function to this particular special case. And what you do is you only train the network using the example that you have. So if you look at the diagram on the right-hand part of the slide, let's say you're missing the first level. Let's say you don't have information about a male policyholder because you're dealing with a female policyholder record. What you can do is optimize your network to predict as well as possible for the female example that you've got. And the way that you do this is by adapting your loss function with an indicator variable. So what's quite amazing about this is that you can fit this multi-output network to exactly the same sort of data that you have in personal lines pricing file. And also very similar to what you'd have in a life insurance context. If you're doing mortality analysis, you'll know the outcome on a particular policy if the policyholder, for example, stayed alive or died. And even though that policyholder will generally only be male or female, you could still fit this multi-output network on that sort of data. And then you can directly estimate your discrimination-free pricing from the network outputs. So how can we use all of our available data? So how can we benefit from the records where let's say you've got a case where you've got three types of records. In some instances, your policyholder might be male. In some instances, your policyholder might be female. And in other instances, your policyholder may not have any information about whether they are female or male. So how can we use all the records, the ones where you have D, which is your discriminatory variables, and the ones where you don't? What you can do is use your network to predict both prices and probabilities for each network. So this is a little bit more complex than what we saw before. It's going to predict, say, frequency and your probabilities. And you can use this in the following setup that we're going to discuss now. So let's say that you have your discriminatory covariate available. You'll train your network to predict the probability of the discriminatory covariate being at a particular level. For example, that this is a male record. And you can also match the observed price as closely as possible. Another case is that, in fact, your discriminatory covariate is not available. And then what you can do is train your network to predict the unawareness price. So this is effectively you represent it by combining both of these cases with the loss function in the slide. And this basically says, if you know what your discriminatory covariate is, just try to predict your best estimate price. If you don't know what your discriminatory covariate, what value it is, work out your unawareness price and try and match the unawareness price as closely as you can using your probabilities that you're predicting using your network. So, sorry, just before we take the question, what the conclusion of all of this is in fact, you can train a multi-output neural network to provide discrimination-free prices, even when you have data that both includes and excludes your discriminatory covariates. And this is exactly what we're going to illustrate in the next example. James, if it's okay, let me take the question.
Yeah, let's go.
So the question is, what is this process stripping out, I guess? Is this meant to remove bias in the data or adjust the assumptions where your data is missing or not very credible? The main idea here is to do two things. You want to remove bias from your non-discriminatory covariates, and you want to be able to exploit all of the records you might have, even those where you don't have your discriminatory information. So let's say you're thinking about ethnicity, you may only know ethnicity for a subset of your records. How could you just strip out the impact of ethnicity on your non-discriminatory covariates, even in the case where ethnicity is missing for the majority of the records? That's exactly what we're trying to sort out here. So I hope that answers the question. I'm also happy to take any other questions now if there are. Okay, I don't see any more. So now let's look at a real world example that brings all of this together. This is an historical data set of personal lines experience in around the year 2000. This was very kindly contributed by an anonymous multinational insurer. This data set has got 19 different rating factors, the sort of things you'd expect in a personal lines data set. And this has got motor coverages in it. So you've got property damage, you've got third-party property, and bodily injury. There's about 42,000 claims and 166,000 years of exposure. And in this particular jurisdiction, this insurer records ethnicity to track insurance market penetration. And in that particular insurer's jurisdiction, there's 5 different ethnicity codes defined. And those are the 5 levels you see on the top right-hand part of the slide. We're not going to disclose the exact coverages nor the excesses in this particular portfolio, which will affect frequency and severity. So really the information that we're going to show is not useful for commercial purposes. You just look at the table on the right-hand part of the slide, you've got 5 different ethnicities and frequencies. You can see that ethnicity code 1 seems to have slightly different experience with frequency that's almost 50% higher than the other 4 ethnicity codes. So ethnicity code 1 is different from 2 to 5. Let's just talk about how we model this data. So we use a deep neural network with embedding layers for categorical data. We fit these networks 20 times and then averaged out the results. And this is what's called the nagging predictor in some work we did in 2020. It was regularized using dropout and batch normalization. I'm not going to bore everyone on the call with what these details are. If you're keen to understand it more, you can see the references in the paper. And we did an 80-20 training and test split and used 5% of the training data for validation. And what you see is the observed frequency in the portfolio split by where you have 2 panels. The left is in the training data set and the right is out of sample, how well you predicted the experience. And on the x-axis in each one of these panels, you have age. So you can see frequency actually peaks at around age 23 or 24 and then has this long, slow decline, quite noisy. And you can see that the best estimate predictions from the network track the experience in the test set quite closely, but is still unable to capture a little bit of the noise that you have. Just worth remembering, 42,000 claims, 20% of that's only 8,000 claims. So it's definitely going to be quite noisy, particularly if you're used to working with a large personal lines portfolio. Let's compare the prices. So on the right-hand part of the slide, what we have is your frequency relative to your best estimate price. So we have your relative to your observed price. You've got your best estimate price in black, you have your unawareness price in blue, and you have your discrimination-free price in red. And what you can see is that, this is all within a narrow range of about 1.5% around your best estimate. Your discrimination-free price is mainly different at the youngest ages in the portfolio, and your unawareness price tracks the best estimate closely. So what that really means is it's possible to implicitly infer ethnicity from your non-discriminatory covariates. In other words, just these two graphs alone show that there's evidence for a relatively minor effect of indirect discrimination in this particular portfolio, and that's what we're going to try to correct with your discrimination-free pricing. Let's look at the impacts by ethnicity, and this is where it actually gets quite interesting. If you look at ethnicity code 5, which is the largest group in the book, there's not a huge difference between your unawareness and discrimination-free prices. Maybe you could say at the older ages, there actually is a problem there. Your discrimination-free price is slightly higher than your unawareness price. And that's because you've got a relatively low frequency for group 5. If we just go back and look at the table, group 5 has actually got the second lowest frequency. So a discrimination-free price will be slightly above that. And then if you want to look at the largest divergences, right, these occur for ethnicity code 1, which is the panel on the left and part of the graph. And then you can see that there's actually some instances where your best estimate price, where your unawareness price is about 5% different from your discrimination-free price. So what does this all mean? What this means is that most insurers will price using an unawareness price, and that could include around 5% of bias using indirect discrimination in this particular portfolio. And just showing what that looks like for your policies, those are the histograms in the bottom left-hand part of the slide. You can see that you even have some policyholders where there's around 10% difference between your unawareness and discrimination-free prices. So in this particular portfolio, in this data set contributed by the anonymous insurer, you can see that you may have a problem for some policyholders greater than 5% of the actual price that you would charge. So how predictive is your discrimination-free price? So a lot of people will be quite worried, particularly in highly contested lines of business like personal lines, to use something that's not very predictive. So what we try to do is measure the difference between your observed claims and each of your best estimates, unawareness and discrimination-free prices. The way we did this is using your callback liability divergence, which is really just 50% of your put-on deviance, which is what you'd anyway be using to train GLMs if you were using GLMs for price. What you can see is that there's relatively small differences between the different sets of pricing. Sorry, the three different types of price on the training set, and there's very, very minimal difference on the test set. So what this seems to indicate is that your discrimination-free price is still almost as predictive as your best estimate price, and in fact, your discrimination-free price overfits on your training set to a lower extent or to a smaller extent than your best estimate price does. So what can you conclude from this? In this particular portfolio, predicting frequency, your discrimination-free price actually doesn't lose a hell of a lot of predictive power. Let's look at the missing discriminatory information. So what we've been showing over here is just really if all of your discriminatory information was available. What I'm showing on this next slide is 3 new cases where we randomly dropped out your discriminatory information with a probability of 10%, 50%, and then 90%. So when you've dropped out 90% of your discriminatory information, you've only got 10% of your data left. And what we did is applied the proposed multitask network approach. What we're showing on the right-hand part of the slide is, again, the callback liability divergence. And what we're looking at is what is the divergence from your best estimate prices, right? What is your divergence from your actual claims experience? So for comparison, we also fit a normal neural network only to those observations where you have your discriminatory information. What you can see if you look at the graphs is that on the training set, your multitask network approach appears worse than your naive neural network. But what you actually see on the right-hand part of the panels is that on your test set, the multitask network is effectively overfitting less. So in your out-of-sample predictions, it predicts just as well as your naive approach of fitting a neural network just to the data that you have. And in fact, for where you only have 10% of your discriminatory information available, it outperforms the naive approach that we've been discussing by some margin. So that's really nice. What this validates is that this multitask approach can work to give you quite robust predictions, even in a case where you've got very little discriminatory information. If you've got all the discriminatory information, or say 90% of it, it's effectively just as good in terms of predictive capacity. If you'd now like to see how well the multitask network approximates the best estimate rates, so let's just unpack that. We've trained a multitask network where you're missing some covariate information, and you're now seeing, well, how well did this multitask network perform compared to if we had all of the data and fit a network without any dropout. And what you can see is that where the most discriminatory information is available, where 90% of it is available, your naive approach approximates the best estimate rates better than the multitask approach. But in those instances where you've dropped out, say, 50% or 90% of your protected information, in this case, your multitask network is as good or even better, significantly better, we might say, than your naive approach of just fitting a network on that subset of the data where the discriminatory information is available. So what can you take out of all of this? Effectively, your discrimination-free price is quite predictive. So you're not losing a huge amount in this particular portfolio if you decide to eliminate indirect discrimination. And even if you only have the discriminatory information for a small subset of your portfolio, you still can derive quite predictive prices using that subset of the information, using the multitask approach that we're discussing here. Okay, so let's think about some conclusions. So what we've done in this presentation, we've only looked about technical pricing. We haven't really thought about office premiums, which will include your loadings for profit and expenses. If your loadings are additive or multiplicative, then your discrimination-free price will also need to be done on your office rate. So my personal view, just from an outlook perspective, is that we know the personal line space is highly competitive. And the method that we've shown here, I think, is a good check for actuaries to use who might be involved in cases where there may be some potential discrimination. But I think it's relatively unlikely that it will be implemented across the market until a regulator intervenes and says, hey, indirect discrimination in insurance pricing is no longer permitted. What we've seen is there's no substantial loss of accuracy by applying discrimination-free pricing. But there are important changes for some groups of policyholders. So how can we say, hey, there's no loss of accuracy, but there are important changes? The way that you can resolve this contradiction, or the seeming contradiction, is the group for whom the discrimination-free price makes a difference is relatively small in this case. And when you really come down to it, what you're trying to predict is quite noisy out-of-sample claims. And it doesn't make a huge difference, even if your prices are different for one group, given how difficult it is to make predictions in personal lines business, where your rate of claim is relatively low. Some more conclusions. So for real world portfolios that are similar to this portfolio or this example, you could use discrimination-free pricing without losing too much predictive accuracy. That might be important for some groups, but you have to have access to some discriminatory information. If you have a little bit of discriminatory information, we've seen that using the multitask approach proposed in this talk, this by far outperforms fitting a model, in this case a neural network, only on that data where you have the discriminatory information. And then maybe just something a little bit more commercially focused. Well, how could you actually get the discriminatory information on some of your portfolio? And it seems quite clear that what you could do is offer some sort of commercial scheme. So let's say you offered, I don't know, a £50 Amazon UK voucher to whichever customer is willing to tell you their discriminatory information. In that case, you might be able to, for a small price, get all the discriminatory information that you need in order to remove the impact of indirect discrimination from your portfolio. And I think this might be something that a company would be able to do for the right incentive for policyholders. That's basically what I wanted to come and discuss with you today. Thank you very much for giving me the platform and allowing me to present this. And with that, James, let me hand back to you. Let's see if there's any other questions or commentary.
Okay, firstly, thanks very much for that, Ron. That was a very insightful, detailed presentation. I had a couple of questions already. So one of them was on just on like the legal side. So at the beginning, you talked about the EU laws there, and they prohibit discrimination on some grounds. So, for example, gender, and I think you mentioned gender and distance driven for car insurance.
Yeah, so distance driven would be a good proxy for gender if you included that in your model.
And gender is prohibited in the EU law. So does that mean
Correct.
if you're doing pricing, I mean, is there a legal challenge there? If somebody doesn't use this methodology for identifying that difference, is there a potential legal challenge if they haven't specifically allowed for this already? I mean, regardless of regulations, there's existing laws prohibiting it. So could you just have a legal challenge on that?
It's really interesting. I mean, to practically have a legal challenge, you'd need to demonstrate that there was indirect discrimination. And I don't think it would be particularly easy for your average consumer to bring that sort of challenge. If you look at the consumer advice body in the UK, in the last 2 weeks, they've actually released a new paper on exactly the sort of topic. So there's definitely more attention being paid. And I suppose at the same time, there's more potential for a proper legal challenge to be mounted. And I think just from a pure professional perspective, my view would be it's probably a good idea to start thinking of how you would deal with that challenge. So I'm not saying that you should apply discrimination-free pricing, but I think if you're working in insurance pricing, it's probably a good idea to read that paper and think about what the implications might be in your particular environment. It does seem like there's more and more focus being paid to this. There's also a case in the US where in one of the states, the insurance commissioner is trying to ban the use of credit scores for exactly this reason. So there seems to be some momentum building in this direction, and what we're trying to offer in this case is a solution.
Okay. There's a question come through there that somebody's just asking if it's legal to ask for customers to disclose the D value, the discriminatory.
So I think what I need to say very clearly is please don't construe anything in this presentation as legal advice. It's definitely not. And you need to consult with a legal authority in the appropriate jurisdiction to see if you could ask for D.
Okay. Another question was on, you had that slide on the neural network and the GLM. So people are probably more familiar with GLM, perhaps, than neural networks. But yeah, okay, exactly that one. So how much are you getting from, so the original piece on the linear model on the right-hand side, how much additional are you getting on the left-hand side? So all the kind of additional pieces of the neural network and so on. What extra accuracy do you get, or is there?
Yeah, that's a super interesting question. I think a lot of it depends on the complexity of the underlying data set. Sorry, I'm just trying to get my light to turn on. There we go. I think a lot of this depends on the complexity of the underlying data. If you've got very complex nonlinear interactions between variables, you can get quite a substantial boost. So if you think about just fitting even a GLM to a normal mortality table, you'd never do that unless you had some splines in there or maybe some quadratic functions and all of that sort of thing. But so if you just naively fitting a GLM, you'll get a very big boost in accuracy using a neural net. If you have got a very well-crafted GLM fit by experts in the particular field, you probably won't get as big an uplift because a lot of that, whatever the neural network can do, will be captured by the fitting process of the GLM. So I don't know if that answers your question, James, but it gives you some feeling.
Okay. Yeah. Okay. And another question was, what would be the kind of main driver? You mentioned regulators, but is that what will be the drivers for implementing something like this for pricing? Is it the regulators? Is there other sort of pressure from other areas, or is it a legal pressure
Yeah,
from?
I mean, I think there's something I always like to think about, which is the newspaper test. If your name was in the headlines that a model you've built contains potential indirect discrimination in tomorrow's Financial Times that everyone's reading on the tube, yeah, I think that's what the sort of question you should ask. So there might be a regulatory imperative, but maybe more importantly is the reputational imperative, and particularly like in a country in South Africa where it's quite easy to consider that certain postal codes will almost surely reflect ethnicity. I think that's where you have to be very careful from a reputational and ethical view. Please also don't construe this as an official opinion on what the APSs and the TASs require of you. I don't think that's, I think that's something that one has to work out depending on which jurisdiction you're practicing in and what your actuarial society or other professional society requires of you.
Okay, great. So there's just, I think, one more question. Somebody asked if you have any back of the envelope validation mechanisms to validate the model results.
Yeah, gee, I would just use this. Just have a look at this sort of table, right? Because this sort of table tells you how well you're fitting on the test set. And so I would just look at out of sample predictive accuracy as a relatively good way of assessing this.
Okay. Okay. Right. Yeah. Okay. Perfect. Okay. All right. Thanks very much, Ron. Thank you for that. That was very insightful presentation. Yes. Thank you.
Thank you,
I think
James.
it's 1 o'clock now, so yeah, we'll call it to a close. Our next event is on the 31st of March, and it's by a presentation by Mike Clark, and it's Wise Finance Poor at Tackling Climate Change. If you have any feedback on today's session, please let us know by email, contact@noca.uk. Otherwise, thank you very much for that really excellent presentation from Ron there. And with that, it's goodbye. Thank you.